Want to be invested alongside Warren Buffett? Looking for a market-beating yield backed by double-digit dividend growth? Like the idea of getting a high-quality dividend growth stock on sale? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is one of the largest banks in the world. The banking business model dates back centuries. And guess what? It'll almost certainly persist for centuries more. Simply put, our society doesn't work without the proper flow of capital, which leads straight to banks. That's part of why Warren Buffett has invested billions of dollars into this particular bank. And it's also part of why I see nothing but growth ahead for revenue, profit, and the dividend. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Bank of America Corp, which appear to be trading at a significant discount today. Bank of America Corp, stock ticker BAC, is a multinational investment bank and financial services holding company. Founded in 1784, Bank of America is now a $284 billion by market cap banking behemoth that employs almost 220,000 people. Operating as the second largest American money center bank by assets, Bank of America has approximately 4,000 branches across the U.S. with representation in all 50 states. Bank of America also has significant international exposure with a global footprint that extends across 35 countries. The bank reports results across the following 4 business segments: consumer banking, 46% of fiscal year 2022 net income; global banking, 32%; global wealth and investment management, 15%; and global markets, 6%. There's a big reason why Warren Buffett is heavily invested in Bank of America. With a position market value of nearly $36 billion, Bank of America represents the second largest position in the common stock portfolio that Buffett oversees for Berkshire Hathaway Inc., stock ticker BRK.B. That reason? The float. The core banking business model is one where money is made from money, and not just money, but other people's money. Access to large sums of low cost and low risk capital via deposits provides a bank the ability to fund loans and other ventures that generate attractive returns. This is why the business model is so lucrative. It's also an enduring business model. Banking dates back to antiquity. Our society has long been dependent on banking and the flow of capital, and unless we want to go back to a hunter-gatherer existence, our society will continue to be dependent on banking and the flow of capital. This basic framework is made to be even more powerful by the fact that the bank is situated inside the world's most powerful economy. Bank of America's roots date back centuries, almost right back to the founding of the United States itself, and I see no reason why it can't continue to prosper for centuries more right alongside the USA, which gives excellent visibility into more revenue, profit, and dividend growth. To date, the company has increased its dividend for 9 consecutive years. Not the longest streak out there, as this bank, like many other banks, was severely impacted by the GFC, but the 5-year dividend growth rate of 17.1% shows atonement for past issues. Now, some of that high growth rate has been propelled by the fact that the dividend was coming off of such a low base. However, the current yield of 2.5% is high enough so as to not require double-digit dividend growth in order to make sense of the investment. That market-beating yield, by the way, is 40 basis points higher than its own 5-year average. I imagine shareholders would be satisfied with high single-digit dividend growth from here, and with a payout ratio of only 27.6%, 6%, the dividend is healthy and easily positioned for a lot more growth ahead. I like dividend growth stocks in what I call the sweet spot, a yield of between 2.5% and 3.5%, paired with a high single digit or higher dividend growth rate. The yield is on the low end of that range, but the high dividend growth rate compensates for this. Very good dividend numbers. Looking at business growth, Bank of America raised its revenue from $89.8 billion in fiscal year 2013 to $95 billion in fiscal year 2022. That's a compound annual growth rate of 0.6%. Not great. I'd certainly like to see a higher number here. However, it must be pointed out that the last decade was extremely challenging for banks. Low interest rates, heavy-handed regulation, and a lumpy economy have conspired to constrain the growth of banks. Meanwhile, earnings per share grew from 90 cents to $3.19 over this period, which is a compound annual growth rate of 15.1%. Thanks to prolific buybacks and a general improvement in profitability metrics, there's been plenty of excess bottom line growth. And this is what has fueled a lot of that big dividend growth. Regarding the buybacks, Bank of America has reduced its outstanding share count by almost 30% over the last decade. Looking forward, CFRA forecasts that Bank of America will compound its earnings per share at an annual rate of 6% over the next 3 years. It's an interesting forecast. I say that because Bank of America compounded its earnings per share at over 15% annually during an extremely difficult decade. With higher rates, a strong consumer, and the GFC far behind us, the future should look even brighter than the past. But I actually like that CFRA is erring on the side of caution here. There is a good reason to be cautious. CFRA sums it up best with this passage, and I quote, "The bank does have exposure to an economic downturn, interest rate volatility, and weaker loan demand from both consumer and commercial customers," unquote. There are concerns that the US could be staring down a recession soon. With the possibility of a downturn coming up, it makes a lot of sense to peel back the growth expectations from a bank. After all, the collective banking industry is the spearhead of the economy, while a large institution like Bank of America will likely feel the effects of a recession very directly. However, a recession is definitely not a foregone conclusion, and I do consider myself cautiously optimistic on 2023 and beyond. I believe that Bank of America can and should do better than CFRA is giving them credit for. Besides, even if CFRA's low number is what comes to pass, Bank of America can still grow its dividend at a high single-digit rate for the foreseeable future. The low payout ratio gives them some leeway on this front. And if Bank of America grows the business something closer to 10%, that sets the dividend up for like growth. When you're starting off with that 2.5% yield, that's a compelling combination of yield and growth. Moving over to the balance sheet, I see nothing to indicate anything other than a rock-solid financial position. The bank has $3.1 trillion in total assets against $2.8 trillion in total liabilities. Bank of America's long-term senior debt has investment-grade credit ratings. Standard & Poor's gives them an A-, Moody's A2, Fitch AA-. Profitability is robust, and there's even been some consistent improvement across the board. Over the last 5 years, the firm has averaged annual net margin of 26.6%, annual return on equity of 9.7%. Net interest margin came in at just under 2% last fiscal year. Bank of America is a financial powerhouse headquartered in the world's economic powerhouse, and the company is protected by durable competitive advantages such as massive economies of scale, high switching costs, unique financial expertise, and built-up relationships. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. I'd argue that all three of these risks are elevated for a large bank. Banks are highly exposed to economic cycles. A recession can hurt the bank's income statement through reduced loan demand and the balance sheet through higher loan losses. While the absolute size is an advantage, it also limits the relative growth that can be produced. Ongoing changes in financial technology may make it easier for upstarts to take market share. Bank of America's international footprint exposes it to geopolitics and different currencies. I see these risks as quite manageable, especially when weighed against the overall appeal of the enterprise. That appeal is amplified by what I believe is a low valuation. The PE ratio is 11.3. Banks usually command low earnings multiples, yeah, but after the stock's nearly 30% drop in pricing from its 52-week high, this seems unusually low. The 5-year average PE ratio for this stock is 13. We can see that the price-to-book ratio of 1.2 is also low and is right in line with its own 5-year average, and the yield, as noted earlier, is substantially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7.5%. With the long-term earnings per share and dividend growth rates respectively both being well over this rate, I don't think I'm being overly aggressive with the model. Keep in mind the payout ratio is very low, and even with CFRA's cautious near-term earnings per share growth forecast, there's no reason why Bank of America can't afford a high single-digit dividend growth rate straight through. While I acknowledge that the next year or two may see modest dividend increases from a prudent management team, the long-term path ahead looks better than the one that's already been traveled. And I must say, that prior path looks really good in and of itself. The dividend discount model analysis gives me a fair value of $37.84. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates BAC as a 3-star stock with a fair value estimate of $37. CFRE rates BAC as a 4-star buy with a 12-month target price of $43. I came out very close to where Morningstar is at. Averaging the three numbers out gives us a final valuation of $39.28, which would indicate the stock is possibly 9% undervalued. Here's the bottom line, guys. Bank of America Corp is a financial powerhouse headquartered in the world's economic powerhouse. The last decade was surprisingly great for the bank, and the next decade could be even better, with a market-beating yield, a double-digit dividend growth rate, a low payout ratio, nearly 10 consecutive years of dividend increases, and the potential that shares are 9% undervalued. Long-term dividend growth investors ought to consider investing in this company alongside Warren Buffett. And now for a special news announcement. Comcast Corporation, stock ticker CMCSA, recently printed great numbers in their Q4 earnings report. The company beat on both the top line and bottom line, and this note from the CEO sums it up best, and I quote, "The company achieved the highest levels of revenue, adjusted EBITDA, and adjusted earnings per share in our history and returned a record $17.7 billion of capital to shareholders," unquote. Gotta love record numbers. The dividend got boosted, buybacks are on, nothing to dislike here, which is why it's one of my top 5 dividend growth stocks for February 2023. Keep an eye on this one. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alert. I'll see you next time.